So far this year, some of the biggest tech stocks have lifted the stock markets. But if you look outside of the top half dozen or 10 largest, best performing stocks, the market's relatively flat this year. But if you're looking to make money in the stock market, you have to look long term and you have to look for the next opportunity for companies that can either continue to grow at rapid rates or maybe you're struggling right now and the market is giving you an opportunity to buy. I'm Jason Hall. This is The Smattering. And we're going to talk about three stocks right now that are growth stocks. All three are high growth businesses that I think are brilliant buys right now. But first, thanks to The Motley Fool for sponsoring our videos. I'm going to give you three great stock ideas right here, but The Motley Fool will give you its 10 best stocks to buy right now. If you go to our special link, go to fool.com/the smattering, and the Fool's going to give you its 10 best stocks to buy right now. Be sure to check out that link after this video. All right, so here's what we're going to do. I'm going to talk about three companies that I am a big fan of that I think are brilliant buys right now for a variety of reasons. I'm going to start in the tech world, and we're going through a revolutionary time. And you might think I'm talking about AI. And yes, artificial intelligence is changing a lot. But what I'm really talking about is the cloud and data and how companies manage the data that they have and that they're gaining to try to leverage it into actionable information to help them be more nimble, be more profitable, and grow their businesses. And one of my favorite companies is Confluent, the ticker CFLT. Confluent is a small company right now that has really big ambitions. They are the creators, the co-founders of Confluent, creators of Apache Kafka. And Kafka is an open source tool that companies use for data streaming. So what does that mean? Instead of the legacy way of handling data with batch reports after you've already collected the data, days, weeks, or even months later to try to get some information that's actionable out of it, you're able to stream that data in real time and to do things with it to improve your business. What does Confluent do? They have this open source product that the co-founders developed, and they have the tools for companies that don't want to actually build on the open source themselves, that want to have a trusted partner to build it, whether you're running it locally or it's in the cloud, which is their fastest growing part of the business. Apache Kafka, powered by Confluent, is a massive growth business. Their cloud version, Confluent for the cloud, they continue to grow the number of customers using it, and those customers continue to spend more money. Now, here's the thing. Confluent is losing money, and they're also burning cash. But the reason they went public a few years ago was to raise the money to aggressively grow. So this is an actively choosing to spend money to grow phase for this business as they're adding scale to get to more profitability. From a valuation perspective, I want to compare it to a couple of big mature tech companies, Microsoft and Adobe. And I'm going to use the price to sales ratio, which can be kind of an empty metric, but there's a reason I'm using it right now. So you think about Microsoft and Adobe, these are two massively successful software companies that get very high gross margins. They also get very high operating margins. So that's why I'm using it as kind of a proxy of Confluent. Trades for about 14 times sales. By any metric, that's expensive, but it's kind of close to Adobe and not substantially more expensive than Microsoft. Now, again, why that metric? Because at scale, I think Confluent is the kind of company that can get the kind of gross margins, operating margins that you see from these software giants. And again, it's so early in its phase of growth. It's about a $10 billion market cap. This is a business that realistically over the next 10 years could be a 10-bagger kind of investment because of the opportunity for growth. So again, there's risk. It's losing money. It's burning cash. The risk is that they don't get to a scale that's really profitable before their growth slows, but I think it's compelling at these prices. We're going to shift into a growth business that's been around for a very long time, and that's Texas Instruments, ticker TXN. Texas Instruments is known for the calculator, of course, but their biggest business is analog semiconductors. And you hear analog and you might think, why would I be interested in a dumb semiconductor? I want digital semiconductors. I want the latest. I want Taiwan Semiconductor. I want NVIDIA. Those are good, but the reality is that for every digital semiconductor in a device, there are multiple analog semiconductors. This is how they manage power. They're so important to how digital semiconductors communicate in the analog real world that we live in. Texas Instruments is a massive leader. They're also highly integrated from the customer acquisition to customers placing orders. Of course, they work with resellers, but a massive amount of their business is direct customers coming directly to them. They have over 100,000 customers. They do the manufacturing. A couple things that they're doing that are really compelling right now is in new manufacturing that they're rolling out, they're increasing the form factor of the wafers that they use to manufacture their chips. And what that's going to do is drive their costs down. It's going to help them be even more profitable, build on their already very strong cost advantage, and help them generate even more income. You look at this company's history, it's grown tremendously, especially over the past couple of decades, and it's bought back a lot of shares and it's paid a good dividend that it's able to grow. Right now, it trades for roughly 21 times operating cash flows. Now, here's the thing about that 21 times operating cash flows. The semiconductor industry is in a bit of a down cycle. So if you look at the company's operating cash flow, it's fallen from the peak during 2022. Now, so I'm saying you look at this stock, you look at its operating cash flow, $8 a share. It was well over $9.50 a share at the peak of the cycle. So you think about the mid cycle as we return back to growth in the semiconductor industry. This is a good price to pay for what I think is a high quality business that still has a lot of growth left in it. All right, one more for you, and we're going to pivot. This is a little bit of a turnaround, but also still a growth story, and we're going a totally different direction, and that's Dollar General. This is a stock you probably haven't heard me talk very much about, but it's one that I've followed for a long time. So, of course, Dollar General, famous for its discount stores, largely in rural areas where there's not a lot of big box chains or supermarkets to provide access to those things in markets that might be underserved. You look at the stock price, it has absolutely been hammered over the past year. They've struggled. You would think that a business like this, maybe when the consumer is feeling a little bit of a pinch, they should be doing well, but higher costs, inflation have really weighed on its business and it's struggled. Their cash flows have fallen. There's a company that back in 2020, 2021 was generating in excess of $3 billion in operating cash flows. Over the past 4 quarters, it's generated about $1.7 billion. So it's a massive decline because of costs. Even as revenues continue to grow, higher costs have really weighed on its profitability. I see a business that still has tons of growth. They're still opening new stores and they're going to get ahead of those costs and they're going to be able to return to the long-term story of this company. This is a company that was been able to grow since it went public back in 2009, steadily able to grow its operating cash flow just about every year over year until the inflation pressures of the past couple of years. I think management at Dollar General is going to be able to turn that around. They're going to get back on the right side of it, and they're going to continue to be able to grow the business at the same time. You put those things together, you look at the current valuation, and I think Dollar General is an absolute brilliant buy at these prices. So put it all together. There's 3 great stock ideas for you to take a look at for your portfolio. Don't forget our special offering with the Motley Fool. Go to fool.com/the smattering, and you can get another 10 great stock ideas. They're 10 best stocks to buy right now.